Hello and welcome back to the channel. In this episode, I'm going to give you a portfolio update as usual, but also quite a lot of companies in my portfolio have reported earnings in the past 2 weeks. So we're going to cover that in details and also try to evaluate whether a stock is a buy right now or not. Okay, so this is how the portfolio looks like this week. Last week, I already made a post showing that the portfolio value reached 24,226. And this week we're climbing even higher. The account value is now at 24,394 euros, which brings the total return to 6,000, almost 300 euros. With the net deposits still being at 18,000, I haven't added any new money to the portfolio except this small portion which came from dividends. And as you can see, this is the value that's different between these two numbers, because this is already the money invested and this is total account value. From the list of the companies, you can see that I haven't changed anything with the positions. And let me just scroll down. You can see that the list of positions is still the same. You can see that some of the companies have lost a bit in value. Some of the companies have added in value. But my biggest portfolio drivers are, of course, on the top. And you can see that Alphabet is currently at almost 3,000 in gains. Amazon added quite a bit after reporting earnings. ASML is also at almost 100% returns. So this is what we will be discussing next. What kind of earnings have these companies reported, who actually reported the earnings, and how it affected the stock price. For checking earnings, I'm using this tool called Qualtrim, and it has this nice view of earnings calendar. And we will be starting to look at the week from April 27th and the week from May 4th to May 10th. As you can see, both weeks have a lot of companies reporting earnings, but previous week was even bigger because on Wednesday, a lot of big tech companies were reporting their earnings. And you can see that we have Google, Microsoft, Amazon, Meta, and right the next day, Apple reporting their earnings. To make it a little easier, I'm going to filter only by my watch list, and it means only the companies that are in my portfolio. And with that, we can see that on Tuesday 28th, S&P Global and Booking reported their earnings. And then on Wednesday, we had this massive day of big tech reporting their earnings. And then on Thursday, we also have Mastercard. We also had Visa on Tuesday, but Visa is not in my portfolio. And then this week, we also had Duolingo reporting on Monday. So let's start in order, with the first one being S&P Global. And right here on the graph, if I zoom in a little, we can show analyst estimates versus actual projected earnings per share number that S&P Global has reported. And we can see that analyst estimations were lower. So S&P Global beat on EPS, and also it beat on revenue expectations. However, the stock is still trading slightly down, and we can better see it on the graph here. So for the past month, the performance is minus 2.3%, and around here, S&P Global reported their earnings, and we can see it continues slightly down up until today. We can also see what's happening with the company year to date. We can see that it's down 18%. From February, it started declining, and in here, they reported their previous earnings. And let's check what happened in there. We can also see it from this sidebar view. We can see that earnings per share missed, and that caused a drop of around 10% on the day for S&P Global. Now, what is happening exactly with S&P Global? Let's have a look in here as well. From the latest news, the outlook on the company is bullish. It's beating on its earnings per share, revenue, net income is growing above analyst expectations. But what is the weakness? And we can actually see it in S&P Global's earnings release in here for the full year 2026 outlook. They're guiding for revenue growth of around 6 to 8%, and that yearly EPS will be around $19.40 to $19.65. But what is the problem with this outlook? It's that right now we can see that their average revenue growth for 10 years is around 11%. For the past year, it's almost 8%, and now they're guiding that it can be from 6 to 8% for this year. And this is the reason why we're seeing this sell-off in the company. Another reason is potential AI threats and automating this financial analytics. But I don't think it's a problem for S&P Global. And in here, we can also see that they're actually working on incorporating AI in their software. And S&P Global has a lot of proprietary data that they don't share with OpenAI and Claude models, for example. So I think in this case, AI will not be disrupting this company, but instead helping it deepen the platform's competitive moat. And also, let's have a look at the company's metrics right now. For the trailing 12 months, the PE ratio is around 26. For the next 12 months, it's around 20. And the free cash flow yield right now is 4.3%, excluding the stock-based compensation impact. So if we have a look at historic valuations of the company in terms of price to earnings, we can see that right now with its price to earnings of around 26, and for the next 12-month value of around 20, we can see that it's trading quite close to its historical lows. For example, during pandemic, it was at PE of 22. And when we're looking at free cash flow yield, we can see that it's currently also quite high to where it has been historically over the past 10 years. In here, we can also see that the historical value of free cash flow for S&P Global during pandemic was around 5.6%, and now it's at around 4.37. Also, keeping in mind that overall metrics are going in the right direction for this company. Revenue, net income, cash flow, EPS, dividends, everything is growing. From the cash and debt graph, you can see that they took additional debt, but if we switch to quarterly, we can also see that from quarter to quarter, they're trying to actively reduce this debt. So in general, S&P Global for me is a great company right now at a decent price. Next up on the earnings calendar is Booking. And let's zoom in again, show estimates. We can see that EPS, slight beat, revenue also beat the analyst expectations. And from this graph, we can see that Booking does this very often. And from 2021, it didn't miss a single quarter. It was always in line with estimations or slightly above. But as we can see, the stock itself is 3% in the red. And if we scroll down here, we can also see the Q1 results. Even though the bookings are growing, the EBITDA is growing, adjusted EPS is growing, and beating consensus on both revenue and EPS, raising dividends, repurchasing 3.6 billion of stock. But the guidance, because of Middle East conflict, is that the gross booking growth will be subdued in Q2, and the 2026 revenue growth projections are also being lowered. But the demand for travel is solid, and I think it will bounce back quickly as well. Booking also completed the 25-for-1 stock split, which means that the per share price was around 4,000 and now it's trading at 165. Now going to the metrics, I will also briefly mention the price to earnings rate for Booking. In the trailing 12 months, it's around 21, and in the next 12 months, the metric is around 15. And when I'm mentioning PE rates of 21 or 15, it's important to take note that the average S&P 500 PE ratio is around 26 right now. So the average company amongst 500 companies in the S&P has 26 PE ratio, which makes Booking relatively cheap in comparison. But I also don't consider Booking to be an average company. So let me show you what I mean. So the first one here is revenue. It's growing consistently quarter over quarter with a very good speed. We can see it only slowed down during COVID in here. Next, looking at gross bookings. Gross bookings are also moving up every quarter. Then going to the next one, room nights sold, also going up and to the right, which I like to see. But with all that, Booking also constantly generates a lot of cash. We can have a look at stock-based adjusted free cash flow, and we can see that for the past quarter, it reported $8.5 billion. There is a slight deceleration, but I think this is temporary, mostly due to the conflict in the Middle East. Just looking at all the metrics, everything is going up and to the right. Booking is also returning a lot of capital to the shareholders via dividends or buying back shares. So I quite like this business, and I think there is a long runway of growth ahead of it. Moving on to the next day, and we can see that on Wednesday we have Google, Microsoft, and Amazon reporting all together. So it's a massive earnings day, and we will be starting with Google. Google is actually up big after the earnings, and we can see, especially when we show estimates, that it posted a killer earnings report, beating earnings per share almost by 100%, and also beating revenue expectations. But to get an even better picture, we will look at Google's earnings report, and we can see that Alphabet's revenue increased 22%, Google Services revenues increased 16%, led by growth in Google Search. So Google Search is still growing despite some fears over ChatGPT that was there last year. 19% growth in Google subscriptions, platforms and devices, 11% growth in YouTube ads, and YouTube ads does not include YouTube Premium. YouTube Premium is under subscriptions, and this is the big line that skyrocketed the stock after earnings, because Google Cloud revenues increased 63%, and meanwhile operating income also increased by 30%. Margins have expanded by 2 percentage points. Net income increased 81% and EPS increased 82%. The company also announced a 5% increase to dividends. So every metric has increased and increased significantly. And we can definitely see this on Google's stock price. This is year to date. It's up 27%. And just over past month, it's up 24%. And this is the point where Google published their earnings report, and it just went up from $349 to $400 now. We can also see from other charts, this is the revenue one, just growing and growing quarter over quarter with an amazing pace of 15 to 17%. I will switch to quarterly to just illustrate the revenue by segment. And if I cross all the rest except Google Cloud, we can see that it just grows exponentially. But not only the revenue of the cloud business grows, but also the operating margins of the cloud are expanding and now approaching 33%. It was just at 2.6% in Q1 of 2023. And then we can also see that cloud backlog, which is contractual commitments from the customers for next years, is also growing exponentially. And we can see that it went from 92 billions in Q1 of 2025 to now 460 billions in Q1 of 2026. It might be a one-off event because 200 billions of it was commitment by Anthropic and their Claude models, but still it's an impressive growth. And then we can also look at net income, which is just massive. If we have a look at the growth of net income, this year-over-year increase by 81% is just phenomenal. However, if we take a look at the cash flow, it's a slightly different picture. We can see it's decreasing, but the reason for that is that Google is spending a ton on CapEx. Right now, they're building a lot of infrastructure to cater for AI demand and Google Cloud demand. So right now, this metric doesn't show us much. Continuing in this fashion, earnings per share growth moving in the right direction. They're sitting on a massive cash pile. They're growing their dividends. They're buying back shares. Their ratios are improving. Return of capital decreased right now. But again, this is because they're spending a lot on CapEx and infrastructure. My expectation is that Google in a few years will be in a position to return even more capital to the shareholders. And now lastly, we can also look at the valuation. Very good opportunity to buy was April 2025, and then Google's price to earnings went up, which means Google is not really cheap right now, and we can see it reflected in the cash flow as well. By the cash flow metric, Google is expensive at the moment. The next company on the earnings list is Amazon. Let me zoom in just a little bit in here and also show the expectations. Amazon also beat significantly on EPS. And on revenue, they also delivered above analyst expectations. And if we go to the company profile page, Q1 2026 for Amazon was amazing. They crushed expectations. In fact, Amazon reported 17% year-over-year revenue increase, which is driven by accelerating AWS growth and higher service mix. They also gave guidance on Q2 operating income to be higher than expected previously. And also there are news that AWS launches partnership together with OpenAI. Anthropic also commits 100 billion to AWS, similar to Google, over the next 10 years. And now let's just quickly look at general metrics. On price to earnings, Amazon seems already a bit expensive. On free cash flow yield, it's definitely expensive. And let's look at the graphs now quickly. For the stock price, we can see that for the past month, Amazon is up 13%. The stock was already climbing during April, and after earnings date, it continued its path upwards, although definitely slower than Google. And year to date, the stock is up 20%. Now let's also look at revenue. Year-over-year increase of 16%. For the past 10 years, the revenue growth is around 20% for Amazon, which is great for the company this size. And from the revenue by segment, I also wanted to highlight this particular part about AWS specifically. So if we cross everything out, we can see that AWS itself, which is the biggest cloud provider, grows at a rate of 22% per year. And now it's re-accelerating, already going up to 28%. And we can see it on this graph as well, how AWS year-over-year growth re-accelerates. Similarly to Google, we can see that cloud customer commitments are way up. And I think this one is also including 100 billion from Anthropic. Again, very similar to Google. If we scroll down here, we can see that free cash flow is all over the place, and now it's in the negative because of how much investments Amazon is doing into AWS infrastructure and AI tooling. They're also gaining a bit of debt, but at this point it's not anything to worry about. And with Amazon, I know they can definitely turn it around and focus on profitability, but right now they're just not returning capital to the shareholders. They're focusing on growing the business. Still a very good company for my portfolio, and I'm going to keep it there long term. Last big tech cloud provider company reporting on Wednesday is Microsoft. Let's zoom in here as well. We can see that compared to Google and Amazon, they just slightly beat on their earnings per share, and they also beat on their revenue expectations. And if we have a look at the company profile in here, the stock is slightly down on the day. But let's scroll down to Microsoft earnings, and we can see that it beats for the Q3. Revenue reported of around 83 billion, with Azure growing 40% year over year, and overall results exceeding expectations on revenue, operating income, and EPS. The AI-related businesses are also growing fast, up 120% year over year, underscoring AI-driven demand. From this page over here, we can also see that OpenAI exclusivity with Microsoft has ended, and now Google Cloud and AWS can also integrate with OpenAI models. And now let's have a look at Microsoft stock price. We can see that year to date it's minus 12%. However, for 1 month it's plus 8%. And it's reported earnings right about somewhere here. And we can see that after earnings, it dipped, and now it's slowly coming back up. And we already saw that from the earnings, everything was moving in the right direction and beating analyst expectations. So these stock moves are mostly just about OpenAI exclusivity, CapEx spend, and just not growing as fast as AWS or Google Cloud. For all other metrics, we can see that Microsoft's revenue is growing very fast, very stable. Cloud backlog is also growing very fast. It has very good net income graph, growing at 15 to 20%. The cash flow also looks like other clouds, a bit messy because of all the spend on the infrastructure and AI. But for example, compared to AWS, cash is looking better. Dividends are growing, return of capital is still in a good position, shares outstanding are slightly going down, and the valuation for Microsoft right now doesn't seem so demanding. We can see on the price to earnings metric, it's not as high. I'm used to seeing it at around 30 something, but with the free cash flow, it's not as attractive as it can be sometimes, for example, in 2022 or during COVID, but it's still relatively close. Last two companies are left to discuss, and now we're going to talk about Mastercard. As usual, let's zoom in, show analyst estimates, and we can see for Mastercard it's usual to beat earnings per share and also to beat on revenue. We can even scroll here in this list and we can see that to the point of 2021, Mastercard seems to always beat earnings estimates. And to talk about earnings in a bit more details, Mastercard reported adjusted EPS of $4.6 versus consensus of $4.41. And the net revenue had a 16% year-over-year increase. Operating margin also expanding to 60.8%. The stock is still slightly down, and this is related to full-year guidance because Mastercard noted deceleration in switched and cross-border volumes, which is partly related to cross-border travel. And also there is some restructuring in order to fund long-term growth initiatives. On a graph, it looks like this, and we can see that Mastercard for the past month is down 2.5%, and year-to-date it's down 12%. However, everything with the fundamentals of the company is strong. We can see that the revenue grows very predictably and very fast at 15% year over year for a long time already. The same applies to net income. Net income grows even faster. EPS also grows at 16 to 20% year over year. Free cash flow looks also amazing. It's a free cash flow machine. And even with stock-based adjusted cash flow, we can see clearly there is a very fast growth, and the growth even accelerating in the past couple of years. They're paying and growing dividends, they're returning a lot of capital, they're buying back their shares. Fundamentally, everything is great with the company, and I'm expecting a bright future with it. Looking at the valuation for the past 10 years, and it looks like right now is a decent opportunity buy. It's very close to what it was in 2022 when overall stock market was down, and also 2020 when the pandemic hit. And on the price to earnings, it also looks fairly cheap. So I'm considering to add more to this position in the future. And last company that I own that reported earnings on just this Monday is Duolingo. We can see a brief summary right in here. It delivered above analyst estimates on earnings per share and also on revenue. And if we go and check the company stock price on this graph, we can see that for the past month it grew by 15%. So the earnings happened right around here. It dropped right away after earnings, then it climbed back up, then it dropped back again. It's a very volatile stock, so it's a smaller position in my portfolio, but I still quite like it and I want to keep it. And if we switch to year to date, there's still quite a long path to recovery. What we see from the company metrics is that revenue is growing fast. Subscriptions are also growing very fast. They're gaining paid subscribers. They're growing the number of daily active users. This is the focus right now for the company. Monthly active users seems to grow slightly slower for the past year, but that's all right. We can see that net income is starting to trend in the right direction. Free cash flow is growing. Earnings per share is growing. Cash pile is also growing. They're starting to return on capital by reducing some of the shares outstanding. But you can see from valuations perspective, price to earnings went to around 12 right now. The stock got absolutely crushed at the end of 2025. And if we check it on a free cash flow yield, this is also a good opportunity to start buying into it. And let's also go and check the quarterly report that Duolingo has provided. And we can see that daily active users went up by 21% year over year. Paid subscribers also went up by 21%. Total bookings went up by 14%. This is the biggest concern for investors right now, because Duolingo at the end of 2025 reported that the total bookings for 2026 will be decelerating, and that's why the stock got re-rated. From all the other metrics, we can see that revenue is growing, profits are growing, margins are expanding, net income, net cash is growing, free cash flow is also expanding together with its margin. But as I just mentioned, the problematic part with Duolingo is the guidance on bookings. And for 2026, the forecast from Duolingo is that the year-over-year booking growth will be around 10%. And that's significantly lower than it was previously. For me, I'm fine holding Duolingo as my position. It's currently slightly trending upwards, so I'm not that much in the red on it anymore, but there is still quite a long way to go, and I have patience to do so. Right now, from all this reported metrics, I don't see a reason why I should sell the company. This was quite a detailed overview of my portfolio and how different companies' earnings have affected it during past couple of weeks. I hope you enjoyed it, and I will see you in the next video. Thanks. Bye.